Welcome back. I hope you all enjoyed the launch presentations just a little while ago, and I'm happy to be back on stage to continue on the theme of startups and innovation with a presentation on the state of travel funding. And then I'll be joined afterwards for a panel discussion with some of the industry's most active investors. Don't have the slides. Oh. Okay, so Phocuswright has been tracking travel startups for about 15 years now, and at this point we have over 4,600 companies in our database. This database is available online in our research library for our clients to filter and to browse for themselves and look for trends and look at competitors. It's been recently revamped, and I'm pretty proud of it. This is a screenshot of what it looks like. We use this database to write our reports about travel startups and about funding, and the latest report that I authored just published in our library. So in this analysis, we're looking at global funding over the past decade to travel tech companies that were founded anytime in about the past 20 years, but that specifically have raised funding between 2013 and the third quarter of this year. And if you're familiar with our startup research, and if you're familiar with our research, you may have noticed that this year we changed the title of the report from startups to funding, and that's reflected in this presentation. This is because a lot of the money that has been raised recently in the last few years has gone to more mature companies, whether they needed it to make it through the pandemic or just to reach the next level of scale. So this is an analysis of almost 3,000 companies that have raised money in the past decade. They've raised $86.6 billion in publicly disclosed funding since 2013 through Q3. And an important note on these stats, I excluded from this analysis unicorn companies that have raised more than $4 billion, like Uber, Didi, Grab, Airbnb, a lot of the autonomous vehicle manufacturers, because we track them in our database, but just a handful of companies can really skew the analysis and distort the trends that we want to uncover and that I want to show today. So when looking at funding over the past decade by year, we see that dollars invested on the blue bars first peaked in 2018 at $11.8 billion, which was driven by a flurry of investment into mobility companies primarily. Funding dipped into 2019 and 2020, and then 2021 was an incredible record-setting year at $16.2 billion. And then 2022 just about matched 2018 at $11.7 billion. And one of the main catalysts for this explosion of funding was interest rates being effectively 0% for most of 2020, all of 2021, and part of 2022, because that incentivized investors to search for yield in riskier investments like through venture capital. But through the third quarter of this year, funding has been quite weak relatively at $3.1 billion. It was $2.4 billion through the first half of the year, and at this pace, it'll probably be under $4 billion for the year, and that would be the lowest level in about 8 years, since 2015, 2016. Similarly, the number of funding rounds on the red line is also trending to be down very significantly at 250 through the third quarter. So they'll likely come in well under 400 for the year, and that would be the lowest number in an entire decade. As you see in 2013, there were 422 funding rounds. And these drastic declines would be mainly due to economic factors, rapidly rising interest rates, stubborn inflation, geopolitical tensions, but also sky-high valuations that resulted from that bubble of 2021 and 2022, because as valuations are now dropping, follow-on funding is much harder to secure. Now, looking at funding by region, in the last 6 years, the landscape has shifted pretty dramatically. Asia Pacific, in blue, had accounted for 65% of all funding in 2017, but it's been dropping pretty steadily since, other than the anomaly of 2021 when there was a flurry of many multi-million and billion-dollar rounds to mobility companies again. And Asia Pacific's funding share dropped to 11% in 2022. It's sitting at 12% in 2023, and this is likely related to the major economies, China most notably, having been in a longer lockdown period. Meanwhile, as of 2023, North America's share of funding is shrinking in the purple, And the group of the Middle East and South America and Africa at the top doesn't represent too much, a whole lot of funding individually, but together you can see how they are rising, representing 18% of funding now through Q3. But most notably, Europe in the maroon color, second from the top, has taken the lead over all the other regions with a 41% share of funding this year. And this is something that has not ever happened before in our data. Now, this chart shows the share of the number of funding rounds, as opposed to dollars we've been looking at business companies versus business to consumer companies since 2013. And it's obvious that the ratio of B2B funding rounds is continually trending up over time. And it particularly jumped in 2020 from 40 to 45% when the pandemic hit and investors made a conscious decision to focus more on B2B companies. The ratio now stands at 46% this year, so approaching half, up from a third a decade ago. And I think this is a function of investors recognizing that in most major categories in travel, there are clearly established consumer brands, and B2C customer acquisition costs are just higher than ever. Here I'm showing debt funding specifically, so mainly loans from banks, and highlighting how it shot up in 2022 from under $1 billion to almost $2.4 billion, which would have been a direct result of the low interest rate environment. And it's worth noting almost all of this funding actually went to companies just in the United States. Not surprisingly, so far this year in Q3, or through Q3, debt funding is very weak at only $50 million in the context of interest rates being quite high again and bank failures, such as Credit Suisse and Silicon Valley Bank earlier this year, which was one of the most important banks offering debt funding to startups globally. This is acquisitions that have taken place just since 2018. And 2022 jumps out where there are 86 acquisitions, almost double many of the previous years. And with 39 through Q3 this year will probably be on par with the previous years, maybe a little bit lower. Now that jump in 2022 was likely because as funding tightened, unless there was a clear path to profitability, acquisitions became an attractive exit route for companies that had little runway left. Now, the data on this slide and the next slide come from Campbell & Partners, who are building a comprehensive database of M&A activity in the travel industry. So while Phocuswright's data, our database, has followed travel tech companies for about 15 years, mainly startups, this database is much more broad and tracks even the largest M&A transactions from public companies, no matter how old they are. And this database is based on publicly available data, but Kanban is also collecting and anonymizing undisclosed or previously undisclosed deal values, which is a work in progress. So they're trying to make this the most comprehensive database of M&A activity. And when looking at all M&A activity in their database currently, Kanban has tracked 1,043 deals, where only 199 of them have the value disclosed so far. And the total value of those disclosed deals is still $95 billion. With 2021 being the largest year at $22.9 billion, and 2019 close behind at $22.7 billion. And the most active year in terms of the number of deals was 2018 at 236. 2023 is looking a bit weaker for M&A, might be on par with some of the previous years, similar to what we just saw in the Phocuswright funding data. And also from Kanban's database, when looking at how long M&A deals take to materialize, a little over half of these transactions happen between 6 and 20 years, with the largest share overall being 20 or more years at 29%. Going back to Phocuswright's data, here we're looking at some of the top funded verticals or industry categories and comparing where funding has gone in the last 21 months, just since 2022, as opposed to the last decade, in an effort to see how funding has shifted more recently. And I think a couple things jump out that are interesting. The most obvious is the strength of the short-term rental and corporate verticals, where over the last 21 months, many companies have raised over $100 million, like AvantStay and Hostaway and Guesty in short-term rentals, and in corporate travel and expense, Navan and Ramp, who you just saw on the launch stage. And also that mobility categories are generally down in the last 21 months versus the past decade, including ride-hailing and car rental. But most notably, bike and scooter, which had seen a big boom a few years ago that has now cooled off. Horizontals are business model and technology-related categories that we track. And here with top-funded horizontals, we're showing that the booking horizontal in blue, which captures all transaction-oriented companies on both the B2B and B2C sides, is losing steam in recent years, being down from 80% of all funding in 2017 to 43% as of Q3 this year. And it's being displaced by an increased diversity of investment dollars into horizontals like software as a service, platform as a service, manufacturers, payments, and artificial intelligence as investors seek burgeoning opportunities in more fertile ground. And the AI category is a small sliver here, second from the top on the chart under other. It doesn't have a label. It's 1, 2, 3%. So funding has been picking up a little bit, maybe, in the last few years to the AI category, but it's not taking off yet, even despite the rise of generative AI. So a few takeaways on all this. The first is that generative AI is a game changer, as we were discussing through this whole conference. And funding has started to pick up in AI a little bit, as we just saw. But travel is notoriously slow to invest in new technologies. So we're not seeing a huge spike there yet in terms of venture dollars, at least. But perhaps generative AI will help to kick off a new investment cycle sooner than later and help funding recover. It's still early days, very early. But as always, I think the key is in who comes up with the most innovative applications of any new technology, and that could always be startups or incumbents. An interesting thought to me is that maybe we will see generative AI native companies sprout up, and generative AI could provide an advantage to them the way the internet did to internet native companies like Booking.com 30 years ago, and mobile did for mobile native companies like Uber 15 years ago. I think the billion-dollar question would be, where are there large opportunities where generative AI does represent a major paradigm shift, and incumbents would be hesitant to cannibalize their existing businesses, as happened with brick-and-mortar travel agents and taxi companies? The answer to that is just a bit outside the scope of this presentation. It's a question for all the genius technologists and entrepreneurs out there who always somehow seem to find a way to reinvent things using a technology like this in a way that very few people saw coming. The other takeaway is that money was quite easy to come by in 2021 and much of 2022, but that's clearly over for now. Investors' focus has shifted away from growth at all costs back to fundamentally important metrics like profitability and unit economics. So travel companies interested in fundraising, whether startups or not, hopefully have gotten back to the basics and are prepared to ride out this downturn if they need to raise funding. And I think as much as we might want to believe that funding is driven mainly by visionary entrepreneurs and executives with breakthrough ideas, the reality is that it's very much driven by investor risk appetite. So fundraising will likely remain difficult as long as interest rates remain high, all but forcing investors to remain risk-averse when they can find good yield in safer investments. And in August, the federal funds rate hit 5.33%, usurping the previous peak of 5.26% in July 2007, and being up drastically from a low of 0.08% in February 2022. So I took the first slide of my presentation with total funding and number of funding rounds by year, and I plotted the average federal funds rate on it. And while noting that correlation doesn't equal causation, we have two pretty clear examples here that when the rate rises towards 2% plus, funding amounts come down very noticeably for 2019 and again for 2022 coming into this year. And it's worth noting this applies more to later stage funding than earlier stage, since earlier stage investors aren't quite as beholden to interest rate risk. And of course, later stage is where most of the funding of the dollars show up in the trends. But hopefully 2024 will bring some rate cuts and spur more risk appetite among investors. Best of luck to all the travel companies that are currently fundraising out there. And now I'll be joined by some of our industry's most active investors to further discuss the state of travel funding and whether the boom is really dead or not. Thank you.